What's going on, everyone? This is the Landlording Show, and I am your host, Tim Harstead. This is the podcast where we dive in deep on not just how to buy rental properties, but more so what to do with them after you buy the property. How do you run them? How do you manage them? How do you get profitable? And today's episode, I'm going to be honest with you, I'm a little scared to release. This is something that the gurus that you listen to on YouTube, the other podcasts that you're listening to, they probably don't want you to know. But I'm going to give you guys the truth right now. I'm going to break a myth that everyone has and everyone needs to understand. And unfortunately, it's been going on too long. And I do think that the myth became real for a short period of time, but over decades and decades, it's just not the case, and we need to talk about it. That myth is cash flow. You may be getting into real estate because you think that cash flow is going to replace your job. Cash flow is going to give you extra money to live month to month. But I'm going to give you a dirty secret that they don't want you to know, and that is that cash flow is not real. When it comes to investing in real estate property, there are 5 ways of making money. And I'll just, you can watch another episode on the 5 ways, but I'll really quickly just give them to you. It's cash flow, appreciation, forced appreciation, mortgage pay down, and tax savings. And people will always talk about cash flow, finding properties that cash flow. And in today's market, it's really hard to do. And realistically, depending on how you're calculating cash flow, you probably never made the cash flow that you thought you were making. So let me preference this by saying, when I say cash flow is a myth, I don't mean forever. I don't mean that it doesn't exist. I just mean the way that most people look at it is wrong. When you first buy a property, and let's say you're renting the property out for $1,000. I'm going to use very small numbers to make math easy and to make the example. You rent a property out for $1,000 and your mortgage is $900. You are now making about $100 a door a month in what people would call cash flow. But here's the issue. Many new investors fall into this issue where they do not have a property reserve and they are not prepared for the ups and downs of real estate. See, overall, over a 10-year stretch, real estate is going to be the greatest investment, in my opinion, that you can have. There's 5 ways, like we just talked about, to make money. You're going to make money in all of them if you do things the right way. But far too many people fall into the trap of thinking that their money that they made month to month is actually cash flow when it's not. The first thing to think about is, what are your costs that are going to come up? Are you going to have to evict a tenant at some point? Obviously, we hope that we never do, but the odds are, if you hold on to a property long enough, you're going to have a period of vacancy or a period of eviction. It is the odds. And the more and more these laws become more and more tenant friendly, the more likely it is that you're going to have what I call a economical vacancy, meaning someone might be in the apartment, but you're evicting them, so they're not paying rent, or a real vacancy for several months. We're in Chicago. You're going to have it for 8 to 10 months when you have to evict someone. If you don't have the cash saved up to pay the mortgage during that time, you are going to be in a super stressful time, and you are going to want to quit. You are going to start looking at selling the home. You're going to sell at a bad time when you're underwater, when you haven't made enough, when you haven't paid down enough of the mortgage, and you haven't had enough appreciation to really make that profit that you need for when you want to cash out. You're not going to be there in 2-3 years. It's going to take 5-10 years of having a property where you start to actually see cash flow. Now, there's a lot of ways to accelerate this. If you have money, if you have reserves, things like that, you can start to accelerate that because you already have that. But if you're coming from the gurus that talk about no money down, get into real estate very cheap, all that stuff, you need to know that you have to put in some sweat equity, and that the first few years, you shouldn't be expecting to make any money off of it. You need to put money away to be able to pay the mortgage for 10 months. You need to have money put away for Look how old your furnace is. An average furnace is going to last 20 years. So if your furnaces were installed in 2000, then you need to know that, hey, I need to have the money put aside to put a new furnace in ASAP because it's going to break down at some point. 20 years again. So we could do this math. Let's say they were put in 2020. We now know that they're 4 years old. So we have 16 years where we expect to put a furnace in 16 years. Take the cost of installing a furnace, divide it by 16, and put that much money into your reserve for that building every year so that you are ready when it happens. Water heaters, average time, 12 years. Roofs. You can look at your roof. You can talk to a roofer and see how old it is and see when you should be estimated to renew your roof. These are things that you should have a tally of. How much do I need in reserves? Sorry for the interruption, but wanted to first of all just say thank you so much for listening, whether you're on YouTube or Spotify or any of the other places. Thank you. Second of all, I want to just touch base on our sponsor, Chicago Style Management, which is my company where we manage property for private landlords in the Chicagoland area. If you have a property and you are ready to make it hassle-free, passive income that is profitable over time, again, with this episode, over time is important, go to chicagostylemanagement.com and take a look and reach out to us today for a free consultation. We'd love to see if we can help you in reserves. If you're looking at personal finance, there's a lot I don't agree with Dave Ramsey, but the one thing he has that you cannot argue with is you need, in your personal finance, you need 3 to 6 months for when you lose a job. How long will it take you to get back on your feet? Well, in real estate, when you have to evict a tenant, how long is it going to take you to get back on your feet to do a turnover? You should have turnover money in reserve. Now, if you come to the table with, you add up all these numbers and you say, all right, I have that money, I can put it in a bank account, put it in a high yield savings account so that you have that emergency fund for when you need it and earn interest on it, make some money on there, great, it's awesome. You have it and you're ready to go. I don't care if your LLC buys stocks, or at least make sure they're not too risky, but I mean, realistically, yeah, let your money work for you, but you need to have it in something that is semi-liquid so that you can get out of a jam when it happens and also start predicting your jams. Know that your furnace is X amount of years old. I have this many years and I expect to replace it. Know your water heater. Know your AC condenser, your roof. Is your plumbing super old? Do you have other issues that you need to know about? Bricks. So many times people do not realize, they haven't had their house tuck pointed in 20 years. And honestly, if you keep up with it and tuck point every so often, it's not that expensive. But if you wait till your house is tipping over, falling down, it is 10, 20, 30,000 to tuck point an apartment. So we have to know this. We have to adjust for it and create that reserve fund. Second thing, we need to make sure that reserve, that our furnaces are lasting 20 years, make sure that everything is lasting as long as possible. So we need to have preventative maintenance, preventative things being done. So don't put a tenant in and forget about it and think, oh, I'm never spending money, I don't have to spend any money. If you're not checking in on your properties at least annually and making up a list of work orders that need to be done so that you can make sure that they don't turn into bigger issues, then that's not good. Are you cleaning your gutters? Because that's going to cause bricks to break down faster. It's going to cause your roof to break down faster. Are we cleaning our furnaces, cleaning our AC units? Those are things that are going to cause issues if they're not preventatively taken care of. Doing things like preventatively rotting out a sink and things like that, using Drano or whatever product you want to use for that to try to alleviate some of the possibilities of having backups that are going to be very expensive. If you have big trees, are you planning annually or every 6 months, depending on how bad the roots are and your pipes, getting your pipes jetted so you don't have any bigger problems or have any backups? These are things that you need to figure out and start doing with your properties on a regular basis. Are you keeping them clean? Are you doing common area cleaning, lawns, things like that? It shouldn't be that you're not spending any money. And I say this for those that already bought properties, but especially if you're looking at properties, when you're calculating the deals, add in the cost for maintenance, preventative maintenance, add in the cost for when you're going to have to do major CapEx things, add in the cost for property managers. You will eventually cash flow, but you have to be prepared to get through the storms. Once you have a property for 5-10 years, you might have bought that property and had $100 spread from the mortgage to what the rent is. In 5 years, I guarantee you're now going to be making $400 or $500 if you do everything right. If you are increasing rent properly and keeping up with tenants and things like that, you are going to increase your rents by 5 to 10% a year, and eventually that $100 is now $600, $700, $800 of cash flow. Get to year 10, now you're cash flowing $800, $900, when you were only cash flowing $100 at a time. So the cash flow is going to continue to grow the longer you hold on to the properties. And that's the last point I'm going to make is be prepared, be ready to have a reserve and have that cash, not spending it. Because when you get to that point where you've had a property for 5-10 years, just because your mortgage is so much lower than the value of the home and what it could rent out for, is when you really start to cash flow. The people that tell you you're going to cash flow from day one, they're just not calculating everything correctly. They're not calculating for CapEx in the future. And they sell this dream that people get caught up in. And so they're in year 2, year 3 of owning a property. They're not making money yet, and they sell it because it's all is lost. And that's not the way to go. Keep the property for 10 years. Let it appreciate for 10 years. Let the rent prices go up for 10 years and watch what happens to your cash flow. Real estate, just like 98% of all investments, are long-term plays and should be kept as such and should be operated as such, because that is where the real money is and that's where the real cash flow is. If you look at the people that they say, oh, all these people made millions and they became the most successful people in real estate, they weren't buying a property, holding it for 2 years and then selling it. They were buying property, buying more property, more, building, just like buying a share of a stock, a dividend stock. You can buy one, but you got to keep buying and buying and buying. And the more units you have, the less it's going to hurt when you have a vacancy, when you have things go wrong. So you got to have all that. You got to have the reserves built up. You got to have that foundation first before you start taking money out as cash flow. And that is where truly you're going to start to see cash flow and start to see benefits of owning property and real estate investments.